All right, welcome guys to the webinar on condos here. There's been a lot of things kind of changing over the last 6 months on condos, and you may have, if you've had a listing or a sale or whatever on a condo, you may have run into some issues as it relates to the condo projects. And today we're going to go over those things. Tim Parent, he's the Vice President of Project Standards at CMG Home Loans, CMG Financial. And what that is basically anything that has to do with a condo, he is in charge of. So he deals with Fannie, Freddie, FHA, VA. You just heard him maybe talking about some of the investors that we deal with as well. But he knows the condos backwards and forwards. And so we're going to take basically, maybe a half hour here to go through some stuff. But what I want to do, it's a small group of people. So if you want to unmute yourself and ask a question right in the middle of the presentation, completely okay with doing that, because your question is probably something that everybody else is going to have to deal with as well. And so I'm okay. Tim, are you okay with doing that?
I love it. I was going to add, yeah, I love Q&A. The more you guys want to participate, the better. Obviously, I don't want to bore you to death with my presentation. So, love some question and answer, scenarios, live topics, anything you guys want to throw at me. That's what we're here for.
Perfect. All right. Well, I'm going to turn it over to you, Tim, and
Thanks.
we'll get going on it. So go for it.
Yeah. Thanks, Mike. And you already see this screen too, Mike, with the slideshow.
Yep.
Okay. Just want to
Yep.
make sure I get the right, there's three screens these days, too much to keep up with. But yeah, thanks, Mike, for setting the stage. I'm Tim Parent. Fancy title is Vice President of Project Standards, just the condo department, condo underwriting department. And yeah, obviously we make sure your condos are eligible for Fannie, Freddie, FHA, VA financing. We've got portfolio lenders, probably similar to a lot of other independent mortgage companies you've worked with, but we really love edification, making sure everyone knows as little or as much they want to know about how easy or difficult it is to lend on condos. And so Mike asked me to put together this presentation, and we were excited to help. I've got a couple slides, like Mike said, about a half hour's worth of stuff to go through, but I'd love if you guys want to unmute and please feel free to interrupt me and ask questions. We can do more questions at the end. So I'm from the Midwest. I drink a lot of coffee, so I hope I don't go too fast. But please feel free to interrupt me, and we can go back to a slide. We can talk about anything that's not on these slides too. But obviously, as you can see, the title of this presentation is just about recent guideline changes and the current status of the lending market. So with that said, we'll jump right into it. And my favorite slide is this slide, because I feel like I've been on a ton of these presentations, especially when I'm not necessarily a subject matter expert. And it's like, man, you can go way down the rabbit hole with this stuff, obviously. But if you take nothing else away, if you're really busy, this is the screen that I think just simplifies everything. What can I do if I'm a listing agent, if I'm a buyer's agent, to make sure I set everything up for the transaction to be successful, right? And it's not always that easy, but there's things we can do, even from day one or before day one. We're happy to help look at docs before we have a live deal. We have some great, programs where we can lock and list, that kind of stuff. Mike knows way more about, forgotten about, but how does that pertain to a condo? So if you're maybe a listing agent that has a listing in a condo, the more we know up front, the better. Fannie's got a pretty substantial list of approved and declined condos these days. Freddie's building a list, Freddie Mac's building a list, pretty substantial. Obviously, if it's an FHA or VA transaction, FHA and VA have their own approved and declined lists. We also keep our internal list, right, of condos we've reviewed in the past. And if we've approved a condo in the last year, there's a good chance we can even reuse docs, reuse a questionnaire. We don't have to reinvent the wheel on every transaction. So just by having the name of the association and the city, state, zip, we can check that for you. You would reach out to Mike or your loan officer, and we'll get back to you, hopefully within one business day or sooner. Beyond that, sometimes there's not enough info. We've never reviewed it. Fannie and Freddie don't have notes on it. So if it's possible, if you can provide any condo docs, whether it's a condo questionnaire from a different transaction in the building, maybe the listing agent that sold a unit in the building recently, Maybe another lender was working on a loan and that lender had condo docs. Especially if another lender says, hey, we can't close it for this reason. Obviously, that's something that we really want to know about. What was the other lender's issue? Can we use the other lender's questionnaire? It does not have to be a CMG version of a condo questionnaire. Another big piece these days of two, of course, is the budget and the financials. Because even on a limited review, where a limited review doesn't require the budget to contribute 10%, if there's a special assessment, we got to look at the budget and financials to make sure that the project's still financially stable. And the
So,
master
hey,
insurance is
hey,
big.
Tim,
Go
can
ahead.
I ask a question real quick?
Yeah.
So you used a couple of words in there, limited review. So what do you mean by limited review?
Yeah, so limited review is based on the LTV and the occupancy of our subject transaction, depending on the down payment, right? So most of our audience here is probably in California. There's slightly different LTVs and CLTVs if you're working on a loan in Florida, but all their states outside of Florida are the same. 10% down on a primary residence is a limited review. 25% down on a second home or investment property qualifies for limited review.
And
And yeah, go ahead, Mike.
what's the difference between a limited review and a full review?
I was thinking that's where you're going, my friend. There's not a lot of difference these days, and I think that's part of the misconception that a limited review is very limited. There's really only three major guideline differences between a limited and a full review. The budget on a full review, the budget has to contribute 10% of the income to reserves, and there's some caveats, some workarounds if there's a reserve study, but I'll keep it high level for the moment. The other second guideline that applies to a full review that does not apply to a limited review is no more than 15% of the units can be greater than 60 days delinquent on their HOA dues. But if there's a special assessment, then the delinquencies apply even on a limited review, if that makes sense. And then the third guideline that's different on a full review but does not pertain to a limited review is on the insurance. We don't have to verify liability coverage or fidelity bond coverage, which protects the theft of the association's funds on a limited review. So, I think I like to describe it that way, Mike, because I think a lot of people think, oh, probably not required on a limited review. Everything else is required on a limited review. There's only three really big guideline differences between a limited and full.
Perfect. So, and then can I go back to even like when a realtor has a borrower that's called them, a seller that's called them and wants to list their condo for sale, or at least come in and get the information from the real estate agents. Where can the real estate agents go other than, well, can they get the information from the homeowner about the condo, like the HOA docs? Can they get the budget, the bylaws,
Yeah. So, and the bylaws, generally actually don't tell us a ton of information, despite what you might think. These docs here, questionnaire, budget, and master insurance are the three that are make up most of a review. So a condo questionnaire usually needs to be ordered. It usually comes with a charge, and that's a fee when we have a live deal and an intent to proceed that we disclose to the borrower. But sometimes a past lender did a questionnaire in the project. Like I said, if a listing agent did another transaction in this building and they have a questionnaire, call them. If you know that listing agent and say, hey, can I see if I can get the questionnaire from that deal you just closed in unit 101? I got 106. We'll reuse a questionnaire from a different lender. The budget and the master insurance can be obtained by the seller, by the current unit owner, because they're still a part of they're still a part of the association. Unit owners have a legal right to those docs. But the condo questionnaire in particular is something that might be something that has to be ordered. So in lieu of a questionnaire, that's my next follow-up bullet point here too, is if you don't have all these docs really available, a resale disclosure, depending on the state, sometimes tells us a little bit of information. A resale disclosure can't necessarily be used entirely in lieu of a condo questionnaire, but it depends on the state. But a lot of resale disclosures do talk about, is there litigation, are there special assessments, and of course those are two really big points to condo reviews. So even if we get pieces of the information, we'll take whatever we can get, right?
Yeah.
So that's kind of what I'm hinting at.
And just kind of the list, you said that the realtors can reach out to me as to see if it's on our approved list, but they can also go directly to Fannie, FHA and VA. Sorry, not Fannie, FHA and VA, and go directly to the websites and see if it's approved. Is that correct?
Yeah, absolutely. FHA and VA's websites are open to the public. Yeah, we can. They're not on my slideshow, Mike, so we could even include those links or pull it up at the end of the presentation.
simple Google search for FHA approved condos and VA approved condos, and you can start to I mean, that's a good starting point, and you can get to it from there.
Yeah, if you struggle, obviously reach out to Mike.
Yep.
But if you struggle finding those links, looks like Laura's got a hand raised. So go ahead, Laura.
Yes, thank you. I have a question. I have buyers who are FHA approved, and the problem we're running into is that every condo that we go look at, none of the associations are approved for FHA.
Yeah.
So, do you do spot approvals, and how quickly can that be done? And is that really successful?
Love that question. It's actually kind of hinted at the bottom of my screen, and we could talk a little bit more about FHA beyond what's on these presentation too, Laura. But yes, we do spot approvals. HUD hates the term spot approvals. They're called single unit approvals these days. There used to be spot approvals prior to, I think, 2008, 2009, and they were really just a questionnaire and master insurance, 15 questions and master insurance. That's it. Today's spot approvals, single unit approvals, are still require a lot of documentation and still require a lot of guidelines. So they're doable. We still approve a lot of them. I mean, we do probably 2 or 3 a week at least. I have a little bit more limited staff, so it's, might be a 2 business day turn time, but we really try to, exceed those expectations, and we're working on process improvement to lower the turn time on them. But it's a longer list of documentation. It's still a difficult approval because it's still a lot more guidelines than a conventional loan. So we try to set the expectation it could be a 45-day closing. That's my last bullet point on this slide. Is it possible to do it in 30 days or even less than 30 days? Sure, it is. It's not impossible. But I always like to overpromise, underdeliver, or underpromise, overdeliver, whatever. I'm sorry, backwards today. But I try to set the expectation. It could be a little bit longer. It's not impossible. We do a lot of them. I would say, historically, before these new guidelines that we're going to get to in the next slide, conventional was way easier than FHA. But conventional guidelines have changed and gotten a lot harder. And I think they're pretty comparable. I think there's situations where FHA is a little bit harder, but they're not nearly as hard as they were because conventional's gotten a little bit harder.
Right. So one question again, the problem I'm running into is if we want to place an offer, we talk to the listing agent and they say, oh, well, the association is not approved for FHA. And so I say, well, we'll go ahead and get a spot approval. And they say, no, we don't want to wait for that. We already have other offers, so we're not going to wait for that.
Yeah, and trust me, I bought my first condo. My first condo I ever bought was with FHA financing, so I know the frustration, and I do feel like, hey, what can be done? There's not a ton that can be done to speed up the process. I think you can still close in 30 days or less. I try to set the expectation. We have some 10-day closing contracts. That's really tough even on a conventional condo, right? But short of that, I mean, I think that other than just getting the deck list of docs as fast as possible, there's nothing we can really do to control how quickly we can get a condo approved for FHA financing, but it's possible to do it in 30 days or less. It really is. It's not that much longer these days, to your point, Laura, with a spot approval.
Just to follow up on that, Laura, to kind of give a little bit more information, and Tim, you can tell me if I'm wrong, but because CMG is one of the top 10 lenders in the nation, we can underwrite those condos in-house. That's what Tim does for those approvals. So it's called the DELRAP. Is that the right? So
yeah. So go ahead.
Go ahead.
So Mike's also hinting that we can get the whole project approved in-house. So on the converse of it, if you're a listing agent, I know, Laura, this isn't exactly your scenario or your question, but we can get the whole condo approved. Not, these spot approvals are great because they are, I would argue, a little bit faster, a little less guidelines if I'm on the buyer side and my condo is not FHA approved. So I go spot approval every day. There are even some guidelines that are a little bit easier, than a full approval, the full DELRAP, HRAP approval. But what Mike's hinting at, which is a great added resource, a tool in our tool belt that we use frequently, is on the listing side. If you don't have a buyer, certainly we could get docs and pre-review them for a spot approval, but we can't issue a formal approval on a spot approval without a live loan and a borrower. Whereas we could do the full project FHA approval and get approved on HUD's website, which is like what you're not seeing right now, Laura, on a lot of these listings. We could do that for a listing, and if it's free of charge, we don't need a buyer involved. So we do that, as you can imagine, frequently these days for the same reasons that you're running into the issue with your buyer. But if I'm on the buyer side, I just say, hey, we can do spot approvals. We can still try to close them in 30 days or less. It's not impossible. The other thing you might want to talk with the loan officer on the buyer side is, do they qualify conventional? Is it possible? I think a lot of times an FHA loan is the preferred loan, depending on everyone's unique situation, right? I'm a huge fan of FHA, but it's nice to know if I'm on the buyer side and my buyer is pre-approved for FHA, in a worst case scenario, could they go conventional? That's another way to strengthen your offer, to say, hey, we're FHA, we're coming with an FHA offer, but we could go conventional if we had to. And that does
Right.
happen just because we run out of time. But I love that question. And it's a tough situation.
Okay, thank you.
One more kind of just to follow up on that, Tim, is that if I'm a listing agent and I want to open up my pool of borrowers and it's not an FHA approved condo project, that's something that they can come to us and at least start that process of getting
Yes.
the project approved.
Strongly encourage it. And that's this whole screen, right? It's almost more for the listing side, I would say. This whole first slide is about. But yeah, whether it's conventional or FHA, we can review docs before we have a buyer. It's a little bit more involved to get the whole project FHA approved. There are some guidelines that are a little bit more strict for the whole project approval compared to the spot approval. But I don't think it would hurt to try. And we can always start with the full project approval and say it's only eligible for spot approval, for these reasons. But we can review as little or as much for conventional or FHA before we have a live deal there too. It's the only hard part is we can't pay for the docs on behalf of the buyer.
Right. Okay. Perfect. Thank you.
Love that question. Thanks, Laura, and thanks, Mike. Okay, so I want to keep going because there's some great stuff ahead, but I love the Q&A. Thank you, guys, and please feel free to interrupt me again. So we talked about resale disclosures. They do sometimes hit at some high-level stuff that can't really be used in lieu of a condo questionnaire, but they're still pretty helpful. And then we already kind of talked about, helping getting these docs. Sometimes, I hate to involve agents, but I do think in the market that we're in, where every speed is everything, and we have 10-day contracts on conventional loans. I do see some of our really wise loan officers like Mike, and no pun intended, but get help loop in the listing agent and the buyer's agent to push the HOA. The HOA doesn't have a vested interest in our transaction, and they do have full-time jobs that are not to fill out condo docs for lenders. So it does help sometimes to have your listing agent, your buyer's agent push the property manager or the HOA to say, hey, we need that questionnaire back yesterday. Can you please help us get it in so we can get our loan approved? That does make a huge difference. And while I don't always want to resort to that, sometimes it can be the make or break in a market like this, I'll go to the next slide. But again, feel free to interrupt me if you want to talk about anything unrelated to this slide. This slide's all about the new guidelines. And I preface new because they did go into effect with loan applications on or after 9/18/2023. But there were temporary guidelines already addressing most of this stuff. There were temporary guidelines that went into effect actually in late January 2022, late December 2021, depending on if you're using Fannie or Freddie. And basically the guidelines, the gist of the guidelines were, hey, lenders hadn't really been investigating if all the buildings, not just our subject unit, were safe, sound, habitable, didn't have water intrusion, didn't have critical repairs, defects in the major building components. And lenders weren't evaluating how does the special assessment affect the marketability, the value, the borrower's ability to repay, the financial stability of the association. So all of these guidelines are new in the sense that they were new in early 2022, but they have been around for a while. They became permanent guidelines. They were temporary guidelines until that time. So again, preventative maintenance is something we see a lot of. Routine repairs, a roof replacement because the roof's getting old, but the roof isn't defective, the roof isn't leaking. That's okay, right? Even if the repairs aren't complete. But the converse of that, which we do find sometimes, is the roof's leaking. We made some temporary patchwork. We have to replace it. We're working on replacing it. It's not finished being replaced. That's ineligible because there was a defect, right? So it all kind of boils down to, was there a defect or is it preventative maintenance? That's in a nutshell. Most of these new guidelines, but we're looking at stuff that we've never had to look at before. And go ahead, Mike.
So just in our area where Westlake Village, Ventura County, actually Southern California, we've seen a lot of rain over the last year, and that exposed a lot of condos that do have leaky roofs. And so there's actually one in Agoura Hills right now that is going through that. They're trying to raise money to actually pay for replace their roof. And we can't lend on it because there are leaks in the roof, and the HOA is disclosing that.
Yeah, and part of me feels like, taking off my CMG hat and just my own personal opinion is, hey, I think sometimes we're punishing condos for trying to fix stuff that they need to address. I get that, but I also understand that Fannie and Freddie can only deal with what they know about, right? So I had one similarly, Mike, where like they voluntarily got a study to see, the stability of their project, a structural condition. and it said, hey, there's some safety issues, but the building next door, of course, didn't. And understandably, the loan officer and the realtors were like, hey, well, they voluntarily went out and got this report. That's not fair for lenders that are, or buildings that are ignoring this. But unfortunately, it really is. What with the information we have, it's what we can, it's what we know, right? So if we don't know about it because they haven't gotten reports or engineering reports, then there's really nothing we can do about that, unfortunately. But the triggers are: is there a special assessment? And the newest part of this guideline, this whole slide where I bolded, this is the biggest change, is even if there are no mention of critical repairs, there's no special assessments or code violations, they're requiring lenders to ask if there has been any mechanical or structural inspections or engineers report that have been completed within the last 3 years. So we're really uncovering some stuff that I know had never been brought up before. Now, it's not like the sky's falling. A lot of the stuff is still eligible. The amount of work we're doing to get it approved is certainly higher than it has been, and that's frustrating. But CMG has a team that orders condo docs for you, follows up on conditions for you. So we know what we're looking for. We don't want to over disclose, but we're good at getting the minute information we need and turning it around as fast as possible. I value that we have staff that all they do is order condo docs all day long. But I want to go through a few scenarios here real quickly on, like, well, a lot of people say, well, what does this mean? This whole change that we need to look at inspections, engineering reports. So there's a lot of if-then bullet points here, right? If a condo doesn't have any because they just never required to get one, they're not in a code violation, that's okay. They don't have to go out and get one. If they tell us we haven't needed one in the last 3 years, we're not outside of any code violations, okay, great, let's move on. I think about the SB 326 bill in California that the governor signed, where they're requiring balconies to be inspected. So I'm hearing a lot that, well, we have a requirement for our balcony to be inspected by the end of 2024. Well, the due date for the inspection is until the end of next year. So if you haven't gotten the inspection because it's not due yet, you're fine. If you were overdue for that inspection, that would be a different story, right? And I do think as we approach the end of next year, a lot of these balcony inspections are going to uncover stuff that could create issues in financing. But let's go through a few more of these scenarios, and we can open up to Q&A. And Jamie, I see you. Let me just burn through these bullet points, and I'd love to take a bunch of Q&A on this topic. I do have to mention that these inspections are not to be confused with the borrower's inspections. We're not talking about the individual unit inspections that you get with a purchase transaction. And a lot of times people get inspections on single families. They may or may not get them on their condo unit. This is not what we're talking about, because those individual inspections are just inspecting just the unit. This is a project-wide inspection ordered by the HOA that we're looking for. That the guidelines require, I should say. If the condo has one of those reports, but the work was completed, of course, that still meets guidelines. Hey, we had a facade issue, we fixed it. We had a facade issue in 2021, we fixed it in 2022. Okay, great. We have to say we checked and we got a copy of that report, but the repairs are complete, we're done, obviously. If they do have an inspection report, the inspection report might advise for preventative maintenance. It might say within the next few years, you have to address this stuff. But as long as it's preventative in nature, routine in nature, doesn't talk about water infiltration, or doesn't present a safety, structural soundness or habitability issue, then it's routine. It's preventative maintenance, which is probably 95% of the stuff we look at, as you can imagine. There's always stuff that the condo should be working on repairing, but it doesn't always mean it's a defect. But then, of course, if you fall into that last category where there is an inspection report and they do show there's some critical defects, leaking roofs, facade cracking and falling off is a big one we see kind of in the Northeast and some of the colder markets, foundation cracking, windows leaking. I'm trying to think of a few other examples. And the repairs are not 100% complete, then that unfortunately doesn't meet guidelines, Fannie and Freddie's guidelines and our investors' guidelines. So I want to pause because I saw Jamie had a question, and I can imagine there might be some other questions.
Hi, thank you. I joined a couple minutes late, so maybe you already said this, but I just was curious, are you going to be able to send us these slides? Because I'm trying to take notes, and I thought if you're going to send them, then I'll stop trying.
Yeah, I drink a lot of coffee and from the Midwest, so I'm sorry if I talk fast. I'm fine with sharing it, Mike.
It's recorded, Jamie, so I'll send it off. I'll either send it to you, or it'll be up on my YouTube page as well.
Okay, thank you.
Mm-hmm.
You got to subscribe to his YouTube page. He needs more subscribers.
That's right. So, hey, Tim, we have assessments that are coming out. So, for instance, there was an assessment on a certain condo in Los Angeles for the elevator that needed to be replaced, and it was the only elevator in the building. So is that like, is that a deal killer because that's the only elevator? So for people with disabilities can't get to the second floor. Is that why it would be disqualified?
It's such a great question, Mike. And I think elevators and roofs are probably the trickiest ones, and the best and the worst part of my job is it's not black and white always, right? So I've had some where I've approved where it's a 2-story building. The fire department said, if you have disabilities, we'll come in and help you up and down the stairs. They had a backup elevator. That's of course eligible still too. They gave us a timeline and they paid for the repairs. They're in the process of fixing it. We had one where the elevator was unsafe, right? And they needed to replace it. But once they close the elevator, the safety issues alleviated, right? So if it's a 15-story high rise and it's their only elevator, that's
Right.
probably a safety concern for fire safety.
Right.
So it depends on the situation. Devil's in the details. I say that a lot, and I hate to say that, but how big is the building? What are they doing to help people with disabilities? If it's a 15-story high rise and it's the only elevator, that's a concern, because now you have people with fire safety. If it's a smaller building and they've set up some protocols for folks with disabilities, I think that's still doable. But we also want to make sure that they've paid for the repairs, and we want maybe an ETA of when the repairs are going to be completed too. So there's definitely some gray areas on I would say elevators in particular. That's a tricky one.
Yeah. There's also you may get to this later on, but there's a project in Newbury Park via Aldea, I think. Is that right, guys? I think that's the name of it. They were in litigation for repairs. It was a project that they sued the builder at the end of like 9.5 years so that they could meet the 10-year requirement for the lawsuit. Yeah. And so now they actually won the lawsuit. They have, I think, $8 million in the bank now, but now they got to do the repairs. So even though they have the money in the bank, you're still not going to approve to do loan, or Fannie won't approve that project until those repairs are done.
Yeah, it's a great question, Mike. And I'm very aware of this type of lawsuit. They call it construction defect litigation. And of course, the attorneys have caught on to this, right? I would definitely say that, attorneys want to make this look as bad as possible because they're trying to embellish to get the money from the developer, the builder, at the end of the 10-year builder warranty. It's very common in California. I understand why condos are like, hey, well, let's, get some money from our developer. There are some things that I'm annoyed with, right? But the severity of how severe it is hard to judge, right, without having a professional. So the answer is, before these guidelines went into effect, before the end of 2021, once the lawsuit was settled, we were good, right? This did change the guidelines. This does say the repairs have to be complete. Now, I have seen instances where they say, hey, the major repairs are complete. All that's left is a punch list of some cosmetic stuff. Of course, that's fine. Or if it's like, I can't tell if this is cosmetic or not, can't tell if this presents a safety issue. What we will result to, which is not always easy to do, but we've still closed loans this way, is ask a qualified third party to confirm, hey, this repair is outstanding. Does it affect safety, soundness, habitability? Is there water intrusion? So we might ask the contractor to confirm, hey, I know the work's still ongoing. Is this a safety issue? It might not be. And a lot of times it isn't. Now, getting the contractor to confirm that isn't always easy, right? Because we're not paying the contractor. The HOA is the contractor, but we might have to resort to a qualified third party to confirm, hey, even though the work isn't complete, is the building still safe, sound, structurally sound, habitable, and is there no water intrusion, depending on the situation. But if it's just like a couple punch list items where it's like, well, we just didn't paint the railings and this and that, there are instances once that lawsuit's settled where you can still get comfortable with that. But more often than not, you're going to need a qualified third party, or the repairs have to be complete.
Perfect.
Love that question. I want to go on one more little anecdote here, and then we can move on to the next slide. Another ones I get questions a lot about are like balconies versus decks, right? A back deck that sits basically on the ground that's deemed unsafe is still eligible, because once you close off that deck, you rope everything off and you're rebuilding the deck. Well, the safety issues are alleviated, right? You've made sure that there's no more safety, and it's not a major building component. The building can still function without a back deck, right? A porch. But as long as it's not overhanging everything. That's why a balcony is different. A balcony might overhang over another balcony. A balcony usually overhangs over a sidewalk. So a balcony that's deemed unsafe is a whole different layer of risk. So it's, again, Another anecdote that, and I won't go on forever, but the other one that I run into sometimes is like parking lots being repaved. A retaining wall on the edge of the parking lot needed to be rebuilt. So they had to close a few parking spaces to rebuild a retaining wall. That's okay. But then if you have a 3-story parking garage and the building sits on top of that and the parking garage is deemed unsafe, that's different because now you're affecting the whole building, right? So it's all about the major building components. If it's something that's not tied to the main part of the building but was deemed unsafe, that still could be eligible. Like in the examples of back porches, decks, parking lot repaving, retaining walls that aren't, next to the building. Again, I hate to say it, but the devil's in the details with that kind of stuff. I'm going to keep going, but we can always revisit some of this stuff too, guys.
Perfect.
All right. So another unfortunate, I feel like, I don't want to be the bearer of bad news, but another thing we're running into a lot is insurance related issues. And the guidelines have not changed insurance. I want to preface that. But what's happening is with, whether we, care to admit or not, the wildfires, the increased hurricanes, a lot of the cost of insurance, regardless of what region you're in, even if you're like, well, there are a lot of hurricanes in California, they've increased the cost of insurance so much. You've probably seen it on single families, but it's also starting to hurt condo insurance, the master condo insurance. And the problem with it is these policies are very expensive. They're big parts of the condo budgets, and they're increasing dramatically, the premiums. And then the other hard part is if a change needs to be made to the insurance, we as the lender don't have a lot of success in convincing the HOA and their insurer and changing the policy because we don't have a vested interest in that policy, right? The HOA is the client. But you will see a lot of times on Fannie Mae's ineligible list these days, condos being declined due to insurance related issues. So I just wanted to, at least inform you if you guys have come across this, I'd be interested. But these are the most recent issues we're dealing with lately is specifically actual cash values instead of replacement costs on roofs in particular. It might not necessarily just be on a roof, but anytime there's actual cash value on the policy instead of replacement cost, that does not meet guidelines. And you might see replacement cost except for actual cash value on this building or actual cash value on the roofs. It has to be all buildings, all units have to be insured with replacement costs. Deductibles are starting to exceed 5% of the policy limit. That's another one that's been painful because when you get that deductible up around 7.5%, 8%, 9%, 10%, the premiums go way down. So of course the HOA says, wow, this is a great way we can save some money, save some costs. But Fannie and Freddie are really becoming, I've always had this guideline, but they're very strictly enforcing that the deductible cannot exceed 5% of the policy limit. Now, the caveat to this is, hurricane coverage. If the deductible exceeds 5% on a geographic specific peril like hurricane, it's only acceptable if it's a per unit deductible. So instead of seeing 7.5%, 8%, 10%, you'll see 25,000 per unit on the master insurance policy. And that's where I think Fannie and Freddie want to head towards. If you can't get a 5% deductible, you got to have a per unit deductible. So the reason for that is if you have 5 buildings and it's a 10% deductible, if only one building's damaged, the 10% deductible applies to just that one building, not all the unit owners. Whereas if you have a 25,000 per unit deductible and one building's damaged, all 5 buildings are paying that deductible. And then the borrower adds to their HO6 insurance. HO6 is walls and insurance, not your full HO3 policy, but it'll cover your unit's portion of that cost. So I get a lot of questions saying, well, can't the borrower just add this to their HO6? Well, you can't do it if it's a main peril like fire, wind, and the only exception to this is earthquake. And I should mention that because I know you guys are in California, earthquake does not apply. They don't have to have earthquake coverage. The deductible can exceed 10%, totally fine. But hurricane's a big topic one where hurricane deductibles are exceeding 5%. So hurricane would be considered a geographic specific peril, but it's only allowed if it's a per unit deductible. So Fannie and Freddie are really sticking to their guns on that guideline. They want to force condos that are saying, we can't afford, our hurricane deductible to keep it at 5%. Then you got to switch it to a per unit deductible. Probably more than you ever care to know about deductibles than ever. But.
Well, it's an issue in our area. We have a Leisure Village in Camarillo they're not carrying enough coverage. At all. And so that is an issue to lend on some of those units in there. So it's becoming an issue.
And I'll talk about this at the bottom of this past the last bullet point where the GSEs, Fannie and Freddie, are aware of some of these geographic specific issues. And we'll talk more about that in a second. Co-insurance is maybe something you haven't run into much in your area. It's still eligible. It just means we have to actually make sure the policy limit is 100% of the insurable value. In order to do that, the insurer needs to provide an RCE or an insurance appraisal for the whole condo, which is a little bit painful, but more often than not, it still meets guidelines with co-insurance. But again, limited coverage for certain perils like Hawaii. Hawaii is the one I don't mean to single out our friends on the islands, and I know you may or probably don't do a lot of lending in Hawaii if you're a California-based realtor. But I want to talk about Hawaii just because it's interesting how the GSEs are responding. Fannie and Freddie are aware that in the island of Hawaii in particular, there's only 3 insurers for the entire islands. If you look at Florida, Florida's had a ton of insurance related issues, but they have 300 insurers. So the type of coverage that they can get at Hawaii is really a problem where there's just nothing available. Insurers are pulling out. So the Fannie and Freddie are aware of these growing challenges, and guideline changes could be coming as soon as middle end of next year. I think they're just going to look at geographic specific things like this where it's just not available in the marketplace. So I'm not saying this will be an end all be all, a savings for every condo in California, but I do appreciate, I like bringing this up because I appreciate that the Fannie and Freddie are aware that, hey, we can't just waive the risk on insurance, but we're hearing that, insurance is just changing. The marketability, the availability of insurance in certain markets is changing, and they are trying to respond to that. But again, the earliest they've told us the changes would be mid end of next year.
At the end of the day, we don't want another condo collapse where, how many people died in the Florida?
98 people. Yeah.
98. Yeah. I mean, so that's what we don't want. And we don't want your customers going into an unsafe situation where the condo is not viable.
Yeah, and just to add on that, Mike, too, I totally empathize with the fact that every deal is harder to win. Every deal is harder to close. Every deal is, there's just not a lot of inventory. I understand people don't want to give up their 3% rate, right? And so we're sensitive to that too. We don't want to make any deal any harder. And it's not about the borrower's qualifications. The borrower, in most cases, are very, very qualified. But we're trying to protect them from their investment. Obviously, this is all collateral, and Fannie and Freddie care about the borrower's ability to repay, marketability, value, and safety, right? So, as much as some of these guidelines are painful, and finding out a condo doesn't meet guidelines is painful, it's, more often than not, when the buyer sees a lot of this information, they say, oh, well, I don't want to buy in this property anyway. I see the risk. Let's talk about some happy stuff for once. We're talking a lot about blue. These are common misconceptions that have been around for, well, some of them since 2018, some of them even longer. But this is where I do think there's opportunities to win deals in buildings that have been deemed non-warrantable for a long time. And there's actually caveats, workarounds in Fannie Freddie guidelines. And beyond this, I'm going to talk a lot about what does and doesn't meet Fannie Freddie guidelines, but we at CMG have a lot of products that will expand these insurance guidelines. Today, Fannie and Freddie don't allow the deductible to exceed 5%. We have a product that will exceed, the rate's going to be a little bit higher. It's a 20% down product, but we have products that will expand all of these guidelines for the most part. As long as our unit and our building is safe, they're willing to work with us and do make sense deals. So, a lot of this stuff is painful because not everybody has 20% down. Not everybody wants an 11% interest rate, but absolutely we do have investors that are willing to expand these Fannie Freddie guidelines.
And those are considered non-warrantable guidelines?
Correct. Yeah. Or, non-QM products. Yeah. So they can get creative on the credit too, to an extent. They do some P&L stuff, and right, very, very outside the box credit, but they're also comfortable with some risk on the collateral. As long as our unit isn't totally uninsured, as long as our unit or building isn't unsafe. If there's another building in the project that has issues, that wouldn't meet Fannie Freddie guidelines, but we have investors that say, well, our unit's not affected, or our unit's already been repaired. We're okay with the risk there. It is going to be a higher rate. It is going to be 20% down or more. But yeah, we do have a lot of great investors that want to work with us on make sense deals like that. But this stuff, I think, is where we end up, winning a lot of business, whether it's, there is a misconception or a big bank has an overlay, not to pick on the big banks, but a lot of the Chase and Wells retail won't do stuff that's on this list. And it meets Fannie Freddie guidelines. People just maybe aren't aware of it. And that's totally understandable. That's why we're having the call. So I'll try not to read this all verbatim, but I think this is one of my favorite slides too, of course. So rental concentration, the number of rental units, the number of units owned by individuals that rent their unit out, are investment property owners. This is not an issue unless it's new construction. New construction has to be 50% owner occupied. Or if our subject transaction is an investment property, if we're buying an investment property transaction. But even then, you could still, as long as it's not new construction, you can still get an investment property transaction done in a condo that's over 50% rented. In fact, it could be 99.9% rentals. It could be 100% rentals, as long as all their guidelines are met. And on an investment property transaction, the LTV, CLTV, that has to be 75%, so 25% down, right? And then to go a step further, that I think that piece that really surprises people is on a primary residence or a second home, there is no down payment requirements. Whatever AUS allows, it's 3 or 5% depending on the credit for a primary res, and then I think it's 10% on a second home. But we can do owner-occupied second home transactions under Fannie Freddie guidelines, even if it's way over 50% rentals. That's not a conventional guideline, hasn't been really for a long time. The only caveats, of course, again, are if it's new construction, it has to be 50% owner occupied, or if your subject transaction is an investment property and is putting less than 25% down. So
there are some HOAs that maybe won't allow you to have an investment property if the concentration is too high.
Yeah, HOAs can put rental caps in. There's some HOAs that prohibit leasing altogether. But what Fannie and Freddie discovered was unit owners that own their unit as an investment property actually take better care of their, pay HOA dues. They're actually better owners, because if you're not paying HOA dues, the HOA in a lot of times can evict your tenant. So, there's different sets of risk guidelines for any investment property transaction. But the fact that the condo is more than 50% rentals is not as painful as I think as people think. A lot of Chase and Wells, not to pick on them, we love Chase and Wells too, but they have overlays that would prevent lending in a condo that's over 50% rented, and Fannie and Freddie allow that. Now, the next bullet point here is single entity ownership, and these two get easily confused. So we're talking in rental concentration, we're talking about individuals that own their units individually and rent them out. Single entity ownership is one entity, one person, one investor, one group of investors that own a number of units, multiple units in the same building, right? So no single entity can own more than a certain number of units. And I don't know how much lending you guys do in smaller condos, but 2 to 4 unit condos, this does not apply. None of this applies. I should preface that. Not even the special assessments, deferred maintenance stuff. That doesn't apply to 2 to 4 unit condos. The only thing that really applies to 2 to 4 unit condos is insurance requirements. But if a condo has 5 to 20 units in the project total, not just our building, but the total building, then no one can own more than 2 units. If the condo has more than 20 units, then Fannie says no single entity owner can own more than 20% or 25% with Freddie. So that's still a substantial number of units in a building. You get a 100-unit condo, very unlikely someone's going to own more than 25 units, right? And then the really nice caveat is the one that I like to highlight is this third bullet point that I think a lot of people are not aware of, is if a single entity owns more than 25%, they can still own up to 49% if our subject transaction is a purchase of one of the single entity owned units. If there are no pending or active special assessments, the single entity is current on their HOA dues, and the single entity will confirm, at least in an email, that they do plan on selling their units and retaining no more than 20 or 25%, depending if we're going with Fannie or Freddie, or no more than 2 units if it's a 5 to 20 unit condo. It makes sense, right? We're actually trying to get out of the issue where there's no guarantee. And I understand you might be thinking, well, what single entity is going to confirm they will absolutely sell? There's no timeline. There's no set timeline. They still can renew leases. But if they will confirm that, hey, their plan is to not retain more than 20% or 25% with Freddie, or 2 units if it's a 5 to 20 unit condo, if they will confirm they are selling the majority of their units, that still meets guidelines under Fannie Freddie guidelines. So that's a huge carve out. There have been instances where that's saved a lot of deals, where an entity says, hey, I bought all these units, but now I want to unload them, right? And we have investors that, of course, will expand these guidelines as well if we're close but no cigar on a lot of these issues, the single entity ownership issues. But that's a big common one. I understand why investors were smart to buy units at pennies on the dollar after 2008, and now that the appreciation is there, they're like, hey, I'm ready to unload these. I don't want to be a landlord anymore. So if you know of a building like that, please feel free to discuss with me and Mike. And then litigation, everybody's favorite topic that is kind of goes hand in hand with the special assessments and deferred maintenance, similar but different. And me and Mike touched a little bit on it in the beginning of the call. So not all litigation is ineligible. I would guess 65, 70% of litigation is still approvable. But if the litigation is involving repairs from defective work, insurance claims that are not 100% complete, the project is ineligible. So like Mike's situation where they won the lawsuit, but they still haven't made the repairs, that's probably ineligible unless we can determine that their outstanding repairs are not due to safety concerns. Here's the loophole that I think they kind of caught on to, excuse me. And I think it was 18, 19 or 20, they changed this guideline where, a lot of the lawsuits were, well, we haven't filed the lawsuit yet. We're proposing a claim against our developer. We're going to see the developer will settle outside of court. Makes sense, right? You know, if you don't have to go to court, don't want to go to court, there's fees and extra costs. But since it wasn't formally filed litigation prior to 2018, it still met guidelines. Now they say even if it's not formally filed litigation, but it's pre-litigation activity, those litigation guidelines still apply. So I do feel like that, you know, that's kind of closed, I would argue, a loophole. But the most common type of litigation is you can imagine is personal injury, wrongful death, it's slip and fall lawsuits within the building due to just, you know, ongoing everything. And as long as the building's not defective, but someone tripped on a, you know, a wet carpet or something like that, you know, for lack of a better term, it still meets guidelines. The hard part is getting the HOA to confirm the guidelines are met, but the part that we have to get in writing, emails okay, is that the insurance is defending. That's part one. Insurance defending just means they're going to pay for the HOA's attorneys. And then they have to also confirm that if the HOA is found liable or settles outside of court, that their insurance will likely cover any monetary damages. So will likely is key because that wasn't always in the guidelines. You used to have to confirm the insurance will definitely cover. Well, of course, no insurer, no attorney wants to put that in writing. They want to keep their reservation of rights. They want to make sure that if they ever wanted to still deny the claim, they could. But where Fannie and Freddie tweaked the guidelines is to say, well, they don't have to commit to 100% covering the insurance, but they will likely cover it, right? It makes sense, you know. Hey, in our expertise, that this is something that the insurance will likely cover. And it's important because some of these wrongful death or personal injury lawsuits, you know, are in the, you know, hundreds of thousands, even millions of dollars. And you can see why the guideline exists because they don't want the HOA to be impacted negatively financially. And they don't have a financial hardship because they lost hundreds of thousands of dollars to someone, you know, getting severely hurt. So in most cases, the insurance is going to cover. It's just hard sometimes to get it across the finish line. This is where I go back to that first slide saying, hey, sometimes as a listing agent or the buyer's agent, it really helps you to push some of these third parties to give us a concrete answer. We have condo prosecutors. We have people that will ask this question. You don't have to ask this question, but a lot of times they stop us in our tracks and we say, hey, this is the Fannie Freddie guideline. We'll screenshot the Fannie Freddie guideline right from Fannie and Freddie's website and say, if you don't confirm this, we can't close our transaction. And I hate to say it, but sometimes realtor involvement really helps in that situation. Now, the other situation is, what if it's not a wrongful death or a big personal injury lawsuit, but maybe like an individual pipe burst between two units or a small minor issue, right? That's another one that has a nice carve out in the guidelines, which is a common lawsuit that is still eligible. The guides say if the reasonably known or anticipated damages will not exceed 10% of what's currently in the HOA's reserves, that still meets guidelines. So we see that a lot, right? We see, oh, this guy damaged my package that was delivered to me, and it was a $5,000 gold watch, you know, that I lost in the mail. I'm suing the HOA because you know, whatever. Like the most common one that I run into is this individual pipe bursting between two units. The pipe was repaired, but there were water damage, and it's an isolated incident. It's not like the whole building's plumbing is defective, which we do see sometimes, and that's a different story. But an individual rights of internal disputes that are, you know, small claims. If we can get the balance sheet to see, oh, the HOA has 500 grand in reserves and the reasonably known or anticipated damages won't exceed 50 grand, and that meets guidelines, right? That's 10% of what's in the HOA's reserves. So that's another common one. Smaller lawsuits, you know, are obviously something that's less risky. So,
Perfect.
yeah.
We've got, was this the last slide?
That was the last slide. I want to save for Q&A, and I can stay a little longer too, Mike, if we have a lot of questions.
Yeah. So if anybody has a question, you know, now's the time to ask it. I know we've gone over a lot of stuff here, and just want to reiterate before we jump off as well that, you know, we're here to help you to, you know, to make sure that these condo projects are approved and ready to be financed. So that does open up the pool of borrowers that will be able to purchase these homes or these condos. And so, you know, if you have one, reach out to me. I can definitely go work with Tim. But at the end of the day, what I would do if I were you in your shoes as a realtor is just make sure that you do your homework and get as much information up front as possible. At a minimum, if you give me the name of the project and the city, then we can at least go check and see FHA, VA list, and our internal list to see if it's approved already. And if it's not, then we'll just need some more information to be able to kind of help you get that project approved. And we have the resources available to do all of that in-house here at CMG, so that you don't have to wait any longer than you might have to. Because a lot of other lenders, they do not have the authority to just do this that we have with Fannie and Freddie and FHA and VA as well. So, yeah, any last questions that anybody has? Awesome. Tim, thanks for your time. I appreciate it. It's such a good information. And like I said, if you guys have any questions, love to answer them for you. I will be available to get those done for you. All right. Have a great day. Have a great rest of the week.
Likewise.
Thank you, Tim
everyone.
and Maya. Thank
Thanks,
you.
everyone. Bye, team.
Bye-bye.
Bye-bye.